Well, it was that seesaw day in the markets following days of losses and some gains. So are investors getting a little bit nervous? We've got a taking stock think tank. My guests are Charles Lieberman, Chief Investment Officer at Advisors Capital Management. Charles is a former Federal Reserve Bank economist. We never hold that against him. Joan Lappin, he is the Chairman and Chief Investment Officer of Gramercy Capital Management. Great to have her with us. And also Bloomberg Businessweek has called her an investment guru. And we're also joined to complete the trio, Stephen Lieb. He is the president of Lieb Capital Management. His Focus Fund beat over 90% of his peers over the past month. Great to have you all with us. Thank you for joining us. Chuck Lieberman, let me begin by pointing to you. Right now, the stock market basically did nothing this week. Is that a good thing?
After the couple of weeks that we've had previously, yeah, that's a great thing. Usually the market doesn't move in a straight line. It would be abnormal if it did. We've had some very strong gains over the past few months. If you remember, it wasn't that long ago, we were coming into the fall and people were saying that September and October are the two worst months on record. Of course, it didn't happen quite that way. It was actually the opposite. So it's great that we can hold these gains, and longer term, I think we're still in a very positive position, and we'll continue to see the market do well.
Joan, is it important to be a contrarian investor? Because it seems as though we get conflicting news almost every day. One day we hear that the world is going to end and the euro is going to disappear tomorrow and we should sell everything and buy gold. And the next we hear very good results from technology companies, from oil companies, and we think, all right, the economy is slowly but surely growing. How do you maintain this contrarian discipline in markets like these?
Well, first of all, we don't buy index funds or try to in any way emulate what an index is doing. We're basically stock pickers, and like you, we've had a wonderful month and a great year. We're up about 3 times the averages. And the way we do that is we focus on particular sectors or investments, I should say, more than sectors, that what's going on at those companies has nothing to do with what the overall stock market or the economic environment.
A market of stocks rather than just a stock market.
Absolutely.
All right, Stephen Lieb, come in on the conversation because you've been looking at gold, you've been looking at energy as well as emerging markets. Is that also the way to approach those 3 areas of investments?
I think it's the way to approach any area of investment. I mean, I'm very bullish on gold. I mean, I have been for a long time, still am. But even in that arena, it matters what gold stock you buy. If you buy a stock like Nova Gold, which we happen to still like, you do it much, much better than if you buy a stock like Barrick. So it always matters which you buy. But as far as, the next 12 months go, I think it's going to be hard not to make money, whether it be gold, commodities, or stocks. And I think stock picking, as Joan said, is going to be the key to how much you make. But I really am, kind of bullish. I think there's a tremendous amount of money sloshing around in the world, and I think it will find its way into a lot of assets, but I think it's a Faustian bargain. Because at the end, I think these high commodity prices are likely to short-circuit things.
Do you agree, Joan? Do you think that we're going to see higher commodity prices short-term, but that it all ends badly somehow?
Well, we're in a very bizarre economic scenario, and we all know that. So to be a contrarian, you have to just look past that. And your earlier question was about the ups and downs day to day, week to week. And I think to the extent that it's possible, you have to tune that out and just focus in on a particular.
Go ahead, Stephen.
Yeah, I mean, yes, to say we're in an unusual economy, that's true. But this is not something that is just a week-to-week thing. I mean, commodities and gold have been dramatically outperforming the stock market for the last decade. That's not just a transient factor. And what factors led to that, the emergence of China in particular, are not going away. They're still with it. This is a new world that we're in. It's not like a week-to-week thing. This is what we should get.
Shaking his head, and
I'm going to have to disagree.
Go ahead.
Great.
China was a great story 20 years ago and even 25 years ago. Gold didn't start to rally until much more recently. I don't know how you analyze gold, because the only thing that gold is held for by investors in gold is because they think they're going to sell it to somebody else at a higher price.
I'd love to hear contrarian views on gold, because the until everybody agrees, I think gold is going to go dramatically higher.
You've got the last bear standing concept.
But there's so many bears out there, and we're so far from seeing the last bear. I mean, gold's going up right now because we have a bubble in dollars.
All right, we're going to continue the conversation. We were talking about gold during the break, and it really did get everybody a little bit exercised. And Chuck Lieberman, continue this thought process, because gold sometimes gets lumped into this basket of commodities, but it's not an industrial commodity. It's not like silver, which might do well if you see growth in it.
You can't build with it. You can't use it.
Well, you could build with it, but it'd probably be very expensive.
You don't use it for anything other than jewelry. And as Joan was pointing out during the break, jewelry demand for gold is actually declining, and declining pretty consistently. It's not used for anything. The only reason investors buy it is because they think they're going to sell it to someone else who will pay more. That is called the greater fool's theory, and it's not a great way to invest. In fact, I wouldn't even consider it investing. I'd consider it speculation.
Stephen Lieb, is it possible, though, that gold is going to just outrun its popularity, or are there always going to be people who say, you know what, I just love the way it looks, I want to own it? Because or is it a fiat money issue?
It's a fiat money issue, but it is beautiful. I mean, there's a reason that gold is attractive to people. I mean, one of the stories I have, I was writing a chapter in a book about 10 or 12 years ago, and I was running out of things to say about gold. I mean, other than, these trivial anecdotes, et cetera, et cetera. I went to my mailbox, got a copy of Nature, which is a very scientific magazine. On the cover is gold. It doesn't oxidize. It's intrinsically beautiful, but that's not why people want it. They want it because it's a medium of exchange. It's a currency. What can you do with dollars other than buy things? What we know about dollars is they're making as many as they possibly can. 600 or a trillion more of them are going to be made in the next 9 months. Gold is constant, and it's been that way for the last 3,000 or 4,000 years. That said, I hate being bullish on gold. I want someone, Obama or someone else, to give me a reason to be bearish on gold.
All right, well, let me introduce this $600 billion elephant, which is the quantitative easing program whereby the Federal Reserve is pledged to buy U.S. Treasuries. That will add $600 billion worth of money to the economy in some fashion over a period of time. Joan, is that going to be good for stocks? It sounds as if it might.
Actually, I'm not sure I understand your question.
Well, if the Federal Reserve goes out and buys $600 billion worth of
except that
treasuries.
What you have happening is the right hand, a.k.a. the Treasury, as you aptly point out, is printing money like there's no tomorrow. And they're selling Treasury bills, bonds, and notes in addition to that. Who's buying them?
The Federal Reserve, in this case.
Mr. Bernanke is buying them. So it's not a healthy or good situation. Now, there has been a lot of talk in the last day or so about the balance of payments, and the Congress, in its stupidity, because it doesn't seem to know anything about economics, is yelling that it's Bernanke's fault that the trade deficit is where it is. The trade deficit is where it is because some huge portion of it is sent to the people who sell us oil. And if they wanted to solve a multiplicity of problems, create jobs and so forth, they would embark on the Pickens plan and make
the Pickens plan would be to use natural gas as a fuel for transportation vehicles.
And for other things as well. And we have an abundance of natural gas. Oh. And in addition to that, I think you have wind and other solar panels and so forth, which it seemed as if we were leading the way on, and now all of a sudden we've been leapfrogged
China's
by
eating
China.
Our lunch is totally, Joan, I could not agree with her more. I mean, I have problems with the Pickens plan. I'm not quite as bullish on natural gas as she is, but that's a quibble. This country needs an avenue for growth. China gets it in spades. They had a stimulus package the same time we did, which was a much, much larger percentage of their GDP than ours, except theirs was all almost completely devoted toward investment. In terms of alternative energies, they are eating our lunch by far. In terms of solar, they'll be the largest wind producer next year. That massive infrastructure is what they need for alternative energies. If after the war, and then I'll shut up. After the war, 1946,
I don't believe it.
Circa 1946, Pim, and this is important to remember. Everybody talks about debt, pumping out money, etc. Debt as a percentage of GDP in 1946 was much larger than it was now. But you know what the difference was? Is that debt had been spent on on an industrial base that laid the groundwork for 20 or 25 years of prosperity. And if you're growing, you don't worry about that. The problem in this country, and I agree with Joan, is we don't have a real avenue for growth. If we're to spend $1 trillion on renewable energies, I will hate gold, and I will love to hate gold. But we're not doing it. We're nowhere near.
Well,
Chuck Lieberman?
The markets are solving some of this by themselves. If you look at the price of natural gas, it's come down dramatically because of some of the shale.
Yeah, we're under $4 per million BTU.
And it's because of shale gas. We found technology that now gets gas out of the rock very inexpensively. You're going to see a huge increase in use of gas for all kinds of energy purposes. It'll displace coal. It'll displace oil.
Well, let's just apply it to some investment themes, because I want to find out, Chuck Lieberman, does this mean that people ought to go out and buy the shares of certain natural gas companies, those that are participating in the shale plays, the Bakken shale, the Eagle Ford shale, the Marcellus shale?
We're playing it slightly. We've got a better play, which is to buy the pipelines. The pipelines.
You like the master limited partnerships?
That's right, because they will carry the gas no matter who produces it, no matter what the price. The gas producers, the development companies, if the price goes down, they make less money. So we'd rather own the pipelines.
And Joan, I gather you would rather own shallow water exploration in the Gulf of Mexico.
You bet.
McMoran Energy 21.
And I've been on both stocks since last year, really. And they're both up over 100% this year, and more good things are coming for both companies.
All right. I want to thank you all very much. Stephen Lieb, Joan Lappin, Chuck Lieberman, as always, a pleasure.